I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show. So now we got Bradley here. What do you want to ask him?
First question would be like, how did you get started with your first deal?
It takes a team, right? And I frankly don't even know how people go from zero to hero and go from no experience to doing a deal all on their own. I'm not sure that I'm capable of accomplishing that. And now the time to test that theory has passed. My partner's already had experience within commercial as a senior underwriter with the bank, as an investor in a mobile home park.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. I'm very excited for today's show. It's one of our Ask the Expert episodes. We got two great people on the line with us today. We got Bradley Kirschbaum and Sanat Bhandari. So as is typical, Bradley, you're coming in as the experienced investor today. Welcome to the show.
Thanks, Brian. Good to be here with you.
Yeah, good to talk to you again. So, yeah, let's start out by talking about you. Tell us a little bit about yourself and a little bit of history, wherever you want to start, and walk us into, getting into apartment investing.
Sure. So I'm coming up on 10 years in the Navy as a helicopter pilot. And I think by the time this airs, I'll actually be out of the Navy. I'll be going terminal and going full-time with Symphony Capital Group, where my partners and I have been syndicating multifamily complexes around the Southwest for the last 3 years or so. That's been taking off a lot more lately as we put more and more energy into it and more of us go full time. So I'm excited to hit the ground running. It's been a great experience so far. But I graduated from Marquette up in Milwaukee back in 2012. Always had an entrepreneurial mindset, always was interested in economics and investing. So right after I graduated, I started investing in all different types of things, including stocks, equities, just paying attention to the markets in general. Yeah. And I had a short time period in the earlier days there where I was paying attention to real estate a little bit, but hadn't quite yet embraced how impactful real estate really was, especially when it came to cash flow and building true stable wealth that could really be relied upon. But eventually I got smarter about it. And around 2016, 2017, I could see the benefits of commercial real estate, and in particular fell in love with different aspects of multifamily. And right around that time, I knew I wanted to pivot and move into other things in my life. So I started transition and started networking a lot here in San Diego, where I am and where our partnership is based, and ended up meeting my three partners, Jeremy, Keith, and Ellis. And by around 2019, we knew that each of us wanted to push into the syndication business model. And I had some experience at that point investing as an LP, and knew that there was a lot to be had if you were both paying attention to the markets as an investor and participating as a business model, and kind of combining your day job with what you do in your free time, combined with what you like to invest in, just compounds effects, right? So I decided to just put more and more time into studying and being involved in commercial real estate. And here we are a few years later. And last year, we participated in over $100 million worth of purchase priced assets. And we have a goal over the next 12 to 18 months to purchase 1,000 units in Dallas, Fort Worth. And that's right now what we're laser focused on. We've owned and co-GP'd around the Southwest, from Austin, Houston, DFW, Kansas City, and one or two other JV situations in the Southwest that weren't syndicated. But we have decided to shift gears a little bit and really attack Dallas, Fort Worth. So if you're in that neighborhood or you're hunting around for properties there, we'd love to see if there's some synergies, but that's where we're going to be spending our year.
Yeah, I think that's a really nice area. There's a lot of growth going there. I actually was in Dallas in December looking at a couple of investment opportunities. And one thing I like to point out, I live in Idaho Falls. Dallas is growing by the size of an Idaho Falls every year. They're literally adding a city the size that I live in to their overall population, the metro area, every single year. So that's something that I can, put into perspective. Like, drive up to the top of the hill, look over, and I'm like, this is how much Dallas is growing by every single year. But great place. And one thing I like to also point out, the mixing, I guess, your business with your investment philosophy. I'm in a mastermind where we were going over, what we want to do with our business and career and what we want to do with investing in as separate categories. And, I'm looking at the two, I'm like, I kind of see those as one. I mean, my investing is my business, which, simplifies a lot of things. But anyway, that said, so you're focusing on Dallas. Tell us what you like about Dallas besides what we already mentioned, and what type of stuff are you guys looking for there?
Around the United States, there's insane growth metrics right now. In particular, the purchase price is growing, right? So underlying that, we really want to see population growth. We want to see job growth, and we want to see the average household income having a really good delta between what an expected tenant can afford and where that household income is today. So that's a good place to start. And some of those communities in DFW, in particular to the east and northeast, afford a lot of opportunities for that. I'll say that we have participated in and have on our hands right now a few assets that are more or less your quintessential C plus, full renovation, forced appreciation plays. And I like that. Those are bread and butter, great ways to bring rents up. However, now today, looking at price tags changing, logistics creating complications. I was just on a call yesterday with about 10 or 12 individuals in which every single person with a large or small multifamily property or a single family house that was being renovated all said they were over budget and over timeline.
We are too.
And we're trying to hold to our timeline on one of our own properties that's being renovated right now. Luckily, we were able to stash a couple of extra supplies in some extra rooms and kind of prep for increasing costs a few months ago. But it starts to make the conversation around what the risk is and what the control over the time frame is on some of these construction projects a more important thing to assess. And in particular, if you're combining different teams and third parties that don't have synergy and haven't been working together multiple times, the risk factor increases a little bit, however you want to measure that. That keeping that, at the forefront of our mind and combining the other factor that cap rate compression has been happening rapidly, but even without any more compression, you currently have class B plus or A properties in the DFW metro that have, in a particular case we're looking at right now, we've just submitted our PSA today, LOI, excuse me. We have 75% of the units being completed with renovation. The other 25 of these 200 units need to be renovated. And the renovated units that have been leased up in the last 12 to 24 months are now at the same price tag as the unrenovated units. They are putting tenants in the unrenovated units at the same price tag as the renovated units because there's so much demand for someone to just get into a unit right now. Why fight the stream? Why fight the current? Flow with it. Don't take, there's a risk to construction. There's a risk to timelines. And if the market right now is holding to a certain rate that is above your quality, above what your asset can provide, you have to analyze that and consider how much delta that really gives you if you're going to continue to pursue a loss to lease situation, right? In the meantime, that's within that one property. You look at the comps around us, and the comps around us are pushing rents up another $150 and $200 on the single and two bedrooms above what we're underwriting to. So we like the situation. We think everyone needs to look at any asset that they're thinking about on a case-by-case basis, whether the market is hot or whether it's tertiary, and continue to understand what has been underwritten and how the different metrics on that underwriting adjust what the returns look like. It's not satisfactory to say a certain city is too hot or a certain city is overbought.
Yeah.
And it's not satisfactory to say all of this renovation is going to force appreciation on the property, because again, going back to your control of properly completing that renovation, we're starting to lose a bit of that right now in the market. So that's kind of our thought process, and that's what we're looking at and looking for in Dallas.
Yeah. So a couple of points to bring out there, construction costs. I mean, we've had rampant inflation over the last year and a half, and construction costs have gone up a lot higher than inflation has. And on our properties, we are 15 to 20% over our budgets that we predicted or we projected, a year and a half, year and a half ago. So there's definitely part of that. There's also a supply chain thing that you mentioned where, things are getting delayed. So we've had a lot of delays on construction, and, instead of taking, 2 weeks to renovate a unit, a lot of times it's taking 3 or 4. And many times we're waiting for like a washing, a dishwasher or a fridge to arrive, before we can put the assets up there. And the other thing you mentioned, I appreciate you doing it, is you shouldn't over renovate. You need to look at what everyone else is doing. And, just because you renovate doesn't mean you're going to get the bumps. And absolutely true. You got to look to the left, to the right, do a really good, comp analysis to realize, to figure out where you're going to come in with the renovations. I mean, granite and stainless steel isn't always going to give you a premium. There's always a limit to where you can go. So a lot of goodness there, and a lot to unpack. So let's talk specifics now about, one of the deals that you guys have recently done. Is there one that you'd like to highlight and talk about?
Well, even though we're pushing into Texas, we have 2 activities in Kansas City. One, which we just closed this week, 95 units in a community called Stony Brook. Up the road, about 4 miles away, we have another 89 units that was purchased last year. And it actually plays towards the comments I made earlier, where we're working with a co-GP in that situation that we've had an organic, trustworthy relationship for quite a while with now. Once we were cozy and comfortable with them and their experience, which was decades longer than ours and all within Kansas City, we knew that brought a lot of expertise to the table in that market, considering we're an out-of-state player. And it made us feel a lot more comfortable about investing into, a market with underlying great numbers. Selecting your partners is critical, whether you're an LP or a GP, or looking at third parties. So we were comfortable there, and that is why we have done a few deals with them now. We'll probably throw in a few more just because there's natural deal flow there that they're seeing for us, aside from our focus on DFW. Mm-hmm. But those 2 plays are quintessential, C-class, forced appreciation. And speaking to the game plan, I never thought when we were figuring out the business plan there that we would be purchasing the amount of raw material and the amount of washer, dryer, and countertop upgrades in the quantity and in advance of a timeline as possible as we're doing now, right? Just to make up for the variables that everyone's seeing. But what's nice is that the construction team is on site. They're only focused on property number 1 that we have, and they're effectively going to move down the street and flow right into property number 2 on a very like kind, similar contract, garden style, rinse and repeat situation with the property itself. So it's not like they're figuring out the game plan as they move over to number 2. They're just moving over to the location where effectively the same units are and just rinsing and repeating. So kind of in a way already locking up the talent, if you will, and getting them to continue their timeline with us is to our advantage. And that's the kind of play that we have in Kansas City right now.
Yeah. I think there's a lot of benefits to doing that. I mean, once you have the finishes that work, you can pick the finishes. Yeah, there's a lot of benefits, and part of the reason people like multifamily is just the scalability and the efficiencies you get. And if you're renovating, ballpark, you got just under 200 units in Kansas City, you're buying the same LVP or whatever the flooring is, you're buying the exact same stuff. now for 200 units, and you're buying, 200 living room ceiling fans, and you're going to, buy paint, for all of these units. It's going to be the same color. So, you mentioned you can buy in bulk and you can get a lot of discounts. And if you're going to renovate that many units, you can actually take advantage of it. But one more thing I like where your head's at is you're looking at how fast prices are going up right now. And you're using that to your advantage. Like, hey, we're going to buy a lot of stuff right now because it's going to be a lot more expensive 3 to 6 months from now. So you're also, saving money on two different ways there, both in bulk, but also, before the prices go up due to the inflation rate right now. So
Absolutely.
a lot of goodness there. So let's talk a little bit about motivations. And it's probably my favorite question on the entire podcast. I like to peer into people's souls, so to speak. Don't take that literally. I can't do that yet. Working on it. But what's your big burning why?
Something that I've appreciated about my marriage with my wife is that we both have a parallel outlook on life and what our purpose is here on earth. And we really didn't articulate that with each other in the early days. But once we started to talk about it and think about what we're trying to do here over the next 100 years, let's say, we both realized that making an impact in our communities was something we wanted to always have a focus on. And we're trying to do that sooner rather than later. And we have, with a few trusted partners, we have some fairly lofty goals, one of which is to help create the capacity for 10,000 people to effectively move off of the streets. And by capacity, we measure that in a few different ways, which includes creating more units and available properties for the homeless to stay in. So actually, about 2 years ago, I set up a nonprofit called the Canopy Project, and the Canopy Project focuses on finding homeless shelters and other sorts of shelters that support individuals, that effectively keeps them from having to stay on the street. And what we do is work hand in hand with those shelters to understand what their runway looks like. Are they at threat of being shut down? Are they at 100% occupancy all the time? Do they need expansion? Do they need renovation? And when we find potential to put a couple dollars in onto the books of a property or a shelter that would otherwise be shut down or otherwise needs a sum so that they can do a necessary renovation to make, let's say, one more unit available, we try to amplify the situation there and bring in new fundraising that helps support their end goal and help support their community. So we're trying to do effective targeting fundraising for assets that already exist and assets that are threatened to be closed down soon if they don't find financial support outside of their community. So right now, that's how we're approaching the 10,000 unit goal. And I'd like to, as my capabilities expand in different ways and my network expands, get a lot more hands-on with that sooner rather than later. To me, it's a challenge. 10,000, people talk about owning 10,000 units, but I think influencing that type of social support is a lofty goal, and one that I'm going to have to work fairly hard to reach. But how it combines back to business is, again, doubling down on being focused on real estate. The more I learn about real estate and participate in the market and run a business model on it, the better I can probably serve that cause, right? Yeah. And to reach a large number of supporting that many people, I have a particular financial figure that I think it would cost to just straight up build 10,000 units, and it's substantial, and I can't do it by myself. But that's the point. We're going to have to shoot high. I'm going to have to meet a lot of people that can help, and I'm going to have to actually promote that situation and not just think about it inside of my own office. I'm going to have to go out there and talk to more and more people about what I'm trying to do, and that in and of itself will force me to be more aggressive about what we're trying to accomplish. So to me, that's become a focus of ours, helping out our community and communities around us in that way.
Nice. And I'll tie a little knot on something you said earlier. You mentioned where your investments and your businesses and all that stuff align. I mean, it sounds like your charitable arm is aligning along the same lines as well. So doing the same type of thing in 3 different areas of your life. So Well, I very much appreciate that. I think that's a very noble cause. There are a lot of people who need shelter, and as much as a lot of people take it for granted. I know I do. There's still a lot of people out there that don't have a good place to sleep every night, and I think good people like you stand up. The more people who stand up and do something about it, the better it's going to be for everybody. So thanks a lot.
Yeah. I got to throw it in there that my sister is actually a full-time social worker. She works in Hennepin County, AKA the Twin Cities up in Minneapolis. Yeah. And she's got a master's in social work and has a pretty substantial role within the county now. And just watching her and her participation and supporting that is really what influenced me to double down and say, hey, I'm understanding and I'm learning these things, and I'm growing a network that is capable of putting a lot of resources towards undervalued situations. This would be a worthwhile thing to focus on. And frankly, what else is the point of life if not to help other people, aside from, being able to stand on your own 2 feet. I'm good. I'm comfortable with my lifestyle. To want for more would be just selfish of me, frankly. I have fun with real estate. It's an activity. It exercises my mind. I like pursuing it. But putting it to even better use, I think, is ultimately what I should be doing. So we're increasing our focus on that by the month, and I'm excited about it.
Awesome. All right. So I think we talked a little bit about it, but I'm still going to ask the question, what's next for you?
Well, give me 14 days here and it'll be full-time Symphony Capital Group. I've actually got my next flight booked for Texas. I'm excited to get down there and walk a couple properties, see a couple current assets, see a couple of assets that will hopefully be ours, and meet a few of the investors that live in the state as well. But aside from that, working within Symphony Capital Group, I've been focusing on doing quite of our current and future capital raising with accredited investors, as well as kind of operating in a, I guess you could call it COO or asset management position. I like to take as many pieces of operation off the plates of my partners who are very focused on, outward investor relations and promotion, as well as those hard skills of looking at the Excel sheets every day and focusing on the underwriting. So in effect, dealing with all the third parties that actually deal with and manage the properties themselves. I'll be reaching out and working hand in hand with them.
I'm sure they're excited to get you going full time with them too. So probably chomping at the bit as much as you are.
Absolutely.
Speaking of, one of your partners, Ellis Hammond, came on the podcast. It's been at least a year, but if anybody's interested in hearing his story, episode 89 is where you need to look. So anyway, that said, we're going to shift gears and we're going to bring on the other guest we have waiting, Sanat. Welcome to the show and thanks for patiently waiting.
Thanks for having me on the show, Brian. I appreciate it.
Yeah. Well, do us a favor and tell us a little bit about yourself.
Yeah, for sure. Hi, everyone. So I'm based out of Omaha, Nebraska, and I have a bachelor's in computer science and math, and I graduated not too long ago, about to graduate with my master's here pretty soon. Currently, I'm working full-time in commercial multifamily development space. So I work primarily as a financial analyst. So I'm working on the underwriting side of deals. I work on underwriting like new projects, like even like bid analysis and creating bank books and all that fun stuff. From an investment perspective, I currently own a single family rental, and I'm about to close on my second one next month. So pretty soon. And nice. Eventually I'm trying to move on to multifamily units so as to expand my portfolio and scale up faster.
Nice. I love it. Now, incidentally, I have 2 degrees in math too. But definitely, math is a very useful skill, and computer science nowadays, man, very, very useful for a lot of what we do, especially on the analysis side. So what's what brings you into the multifamily space?
Yeah, so my motivation for investing in multifamily like asset classes, mostly to scale my real estate portfolio faster, while retaining the relative stability, because housing is a very stable asset class in general. Along with that, the best part is it's a good hedge against inflation, and there's a lot of tax benefits and potential value adds, which are great in my opinion for building wealth. Plus, I like cultivating relations with other people in the industry. So the fact that real estate enables me to be on that side as well. So I love that, and that's why I'm moving on towards the multifamily asset class.
Awesome. Awesome. Love it. Now, something that I like to talk, you talked about why multifamily, but what's your bigger, deeper, burning why that keeps you motivated and pushing forward?
Honestly, building wealth. Building wealth will be a pretty big one because so I'm an immigrant to the States. So like I came here like with nothing and I started from nothing. So the prospect of building wealth and like impacting communities, that's very appealing to me. I would say that's my huge big burning why. Essentially, I would say it's like an egotistical thing to prove myself that hey, you know, I can do this. I can leave a mark.
Nice, nice. Where were you born?
Yeah, so I was born in India. I was
Okay.
born and raised in India. I moved to States in 2017. I'm from the northwestern part of the country. So the city I'm from, it's called Amritsar, and it's on the border with India and Pakistan. So
Yeah.
yeah.
Yeah, I'm vaguely familiar with that area of the world. I'm sure Bradley's, been over there once or twice too, so somewhere close to that. But yeah, I mean, I've not been to that part, but it's been, being a military guy, that's kind of a focus of a lot of attention. So anyway, that said, let's not talk about that. Let's talk more about the real estate side. And so Sanat, we got Bradley here. What do you want to ask him?
Yeah, I got a couple questions for you, Bradley. So first question would be like, how did you get started with your first deal? Like specifically like first multifamily deal.
Yeah, focus within what Symphony has done. It takes a team, right? And I frankly don't even know how people go from zero to hero and go from no experience to doing a deal all on their own. I'm not sure that I'm capable of accomplishing that. And now the time to test that theory has passed. My partner's already had experience within commercial as a senior underwriter with a bank, as an investor in mobile home parks, and as a capital raiser to some degree with both nonprofits and investments. And I was familiar with how things worked. I was familiar with the benefits. I'd purchased other things, but not medium or large multifamily. But I just said, hey, look, I can bring a lot of other skills to the team that you're going to need. I can understand an organization. I can understand people. And I can understand the importance of accountability and, frankly, trusting but verifying, which is the quintessential Navy phrase of ensuring that other people are doing their job. And that more or less points towards why I'm operating in a human management type of role into the future as we accumulate more and more units. But realistically, it took partners, it took networking. And then once I had the partners, getting the deals themselves, that took more partners, that took more networking. So when you said that you like connecting with other individuals, you like the networking aspect and the collaboration, that's great, because you cannot do this from behind your computer screen. You can do Zoom calls all you want, but you're going to have to get out there and go see the properties, go meet the people who work them, go see the people that live there, ensure that your assumptions about the neighborhood and the community are correct, right? It's a very relationship-based game, and it's just on you to keep finding more relationships and nurturing them and improving them and actually put energy and time into them, right? The things that have moved the needle the most for us have come from the things that we've put the most energy into and the people that we've grown the best relationships with, bar nothing else. And frankly, that is what is pushing us as we spiral our way up to bigger and better things, right? And it's something to just keep at the front of your mind all the time, whether it's deal number 1 or deal number 100. It's happening because you have relationships with those other people around you.
Yeah, I think partnership is the fastest way to success in multifamily. I mean, bar none, just like he said, find partners who are strong where you're weak, or who are more experienced than you, and it makes getting into this industry a lot faster and a lot easier, especially if your partners already have experience.
Absolutely, for sure. So Bradley, where was your first deal at? And what was the size of the deal?
Kansas City was really the first acquisition, 89 units. Class C. It was one of the two that I was talking about earlier. We're just shy of a year on holding that. We had some other activities when we were first joining up, some JV situations in the Southwest and here in San Diego, but that was the first proper 506 Bravo syndication that really fits the syndication model and made us go, from front to back, everything syndication, from subscription documents to working with an SEC attorney, to working with the third parties that now work with us today, including our great co-GP relationship over in Kansas City. That was really number one for our team in terms of the business model that we run today.
That's awesome. Quick question. So what's the difference between the 506B and 506C when it comes to like syndication? I'm vaguely familiar with it, but if you could explain that, that'd be helpful.
I'll put it this way. To round it out really quickly, there's quite a bit of fine print on these things, but 506B, B is for buddies. Your buddies don't need to be accredited. And anyone can really participate. However, you can't promote. And there's a lot of, I wouldn't say gray area, but there are fine lines to pay attention to with that. But I can't shout out to social media that I've got a deal. It's a real winner. Send me your money, right? You can't do that with the 506B, but your buddies and people that you've already had a prior relationship with could be investing. When you go over to 506C or Charlie, C, it's almost like just saying credited or accredited. They have to be an accredited investor. The details on that you can find with an easy Google search, but effectively it's a $1 million net worth outside of your personal home and either $200,000 or $300,000 worth of verified income in your household if you're single or married. And if you're an accredited investor, the United States has basically said, we're willing to allow you to risk your capital in whatever you'd like to invest in. And so long as you make the conscious decision to partner with anyone promoting any kind of deal, you're free to participate. I'm not sure that I quite agree with the accreditation standpoint and laws, and they're constantly changing, frankly. They're constantly being talked about on a yearly or bi-yearly pace. But for now, that's where those laws stand.
I mean, the $1 million accreditation, that's been in place for like 20 years, or longer. I don't know exactly when it's been, but it's been in place for a long time. So they've talked about raising the bar, between 1 million to 2 million, 1 million to 3 million. But end of the day, 506B, like Bradley said, you're limited to friends and family, people who are in your current network. 506C, you can shout it from the mountaintops, but you can only bring in accredited investors. So yeah, pros and cons both directions.
Gotcha.
If you're familiar with the Series 7 exam or other financial exams that are out there, once in a while, I think currently even there's just whispers about allowing there to be an exam you could pass to also establish accreditation and basically prove that you're a sophisticated investor who has a bottom line knowledge of how different investments work. And that could then lead to your accreditation. So that's like one of those conversations that's been up in the air more recently, but whether or not that will come to fruition, who knows?
Yeah.
And the Series 7 exam is for a securities license, right? If I'm not mistaken.
One of the underlying tests.
Series 6 actually qualifies you as an accredited investor now, and Series 7 allows you to be a broker. That's your broker licenses. So very helpful for multifamily as well, is to have the Series 7 licenses. Then you can be a capital raiser and be a true capital raiser. That's all you do. But a lot of what's done, there's a lot of gray area, a lot of legalities that have to be, you have to know how to navigate.
So Bradley, how many assets under management does your team have right now as Symphony Capital?
After closing this deal in Kansas City this week, we're pushing 6 assets. And the goal right now is, if we hit our pace, to roughly purchase one per quarter, excuse me. So hopefully we can call it 10 when 2023 comes around.
Mm-hmm. Nice round number. Good place to get.
That's why we're doing it.
Yeah. Makes it easy. Round numbers on your goals. So now, what else you got? You got time for one more question. You have to bring the podcast to a close.
Yeah, of course. So what does the equity and legal structure look like in your deals?
What does the what and legal structure?
Equity.
Like
so what percentage of?
Yeah. So when you're looking at the splits, we've run a 7 pref. The investor in a class A gets a 7% preferred return. After they've reached 7%, we've done a 70-30 split. I believe there was one property in which when the investors reached a 15% return, the hurdle then changed. That hurdle then changed the split to 50-50. But usually 7 pref with 70-30 afterwards. It's interesting because both sponsors and deal by deal, those splits will change. Yeah. And that is really an effect of what the assumptions are with how the asset can perform, right? It's hard to guarantee a 10 pref and a 70-30 split, depending, if you have weak cash flow, right? If you're waiting for money on the back end, or there might be a thin line throughout the project, you can't, or you should not be making promises towards something that isn't really guaranteed. So people will manipulate the split in different ways, hopefully to the advantage of the LPs and obviously the safety of everyone who's participating.
Yeah. I think splits, that's something that, once you're talking to a lot of people in your network, you start understanding what people are looking to get. But yeah, different investors have different ideas of what they want out of investment opportunities. And a lot of times you kind of align those splits with the target investor that you're looking at. But all right, well, end of the day, we are at a time. So one last question for each of you. Bradley, you get to go first. How can investors learn more about you?
If I use the right hand right up here, if you're watching this virtually, Bradley at symphonycapitalgroup.com. Symphonycapitalgroup.com is our website. Feel free to reach out if you think there's some synergy here. I would love to have a conversation with you. Yep. And see what you're doing in your markets, or if you're interested in what we're doing in Texas and Kansas City.
So yeah, if you're on YouTube, obviously you can see his contact information, the QR code on his virtual background. If you're not, we're going to put that in the show notes for you, so you can just quickly find it.
Yeah, real quick, Brian, this is my office, just so everyone listening knows.
So that's not the virtual background. Okay.
No.
Got it. All right. So that's yeah, cool. I love how you got that, your contact information just hanging back there. It's pretty cool. Yeah. So, all right. Sanat, same question for you. How can listeners learn more about you?
Yeah, so I'm very active on LinkedIn. Please feel free to reach out to me anytime, and I would love to talk to you and see if you have any opportunities, if there's any synergies between us, and just further networking opportunities. Like my LinkedIn is like my first name and last name, so SANAT, and last name's Bhandari, BHANDARI.
All right, and we will have a link to that profile for those who are challenged with spelling. We'll have a link to that in the profile as well, so you can just click and go. So that said, thanks to both of you for being on the show today. Appreciate your time, and hope you guys have a great weekend.
You too, Brian. Good to meet you, Sanat.
Thank you. Good to meet you as well.
Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there.